the pivot that State Street is making? Everybody knows them for ETFs. We all kind of know the sector spider products and everything else. But you're making a pivot towards addressing more of the needs on the mutual fund side of things right now, which is very curious for me because it seems as though everybody for the past 2 decades has been trying to gravitate away from the mutual fund format into more of the exchange-traded fund format. What exactly is driving State Street's desire to be more actively participating in mutual funds as opposed to the ETFs that you guys have been known so much for over the course of the decades? And what exactly is driving that particular move?
Well, Dom, this is a case where 2 things can be true at the same time. We are not departing from the ETF wrapper. We still believe that the ETF technology is the most efficient technology in this market. But we also recognize that the ETF technology is not really the appropriate wrapper for everybody. The reason why I've been so vocal and so passionate about it is because, in my view, the retirement industry is not benefiting from the innovation that the ETF industry is bringing to the market and benefiting from. And the reason for that is structural. So think about regulation, think about technology, think about how these pension plans operate. 401 plans cannot buy ETFs. 403B plans cannot buy CITs. As a result of that, you have a big segment of the retirement industry, around $4 trillion in assets, that are invested in index strategies. So pension plans want to embrace index strategies, but the framework is very fragmented. You have to go across different legal wrappers, whether it is CITs, target date funds, mutual funds, ETFs for some, like my IRA is invested in ETFs, my 401k plan is not. And the enemy of efficiency is fragmentation. So for us, it's not a conversation of ETFs versus mutual funds or entering the mutual fund space, but given that the SEC is now giving an ability, hopefully soon, hopefully when the government reopens, giving an ability to asset managers to have different share classes of the same vehicle, we have been working on creating a mutual fund share classes of our ETFs. That is going to give the pension industry an ability to have the same type of index exposure that they want, that they seek, under a same efficient, cost-effective umbrella. So we want to respect the wrapper, we want to respect the technology, but we want to build something that can be operated at scale so that this industry can benefit from everything we love about mutual fund and everything we love about ETFs.
Now, Anna, you and your team at State Street must have done an extensive amount of market research, investor demand surveys and whatnot, to come to this strategy, at least, to try to develop mutual fund type products that mimic some of the innovative ETF strategies that are already out there. What exactly do you think that demand is like, and just how much would the retirement community embrace some of these ETF type strategies in a mutual fund format, because taxes aren't really an issue when it comes to the mutual fund format versus ETFs, like they are for traditional investors as opposed to retirement-based investors?
That's right. This is a really good question because we have done a lot of work. We have done a lot of research. And I want to go back to something that Todd said a few minutes ago, which is for some strategies, fees are really important. For other strategies, fees are not important. So if you think about the spectrum of criteria, the items that are really important for investors, what problem are we solving here? Because in the end, if we don't produce products that solve a problem, we are not doing our job. And investors look at a number of really defined criteria. Fees, so how much does it cost to get that exposure? Content, what type of exposure? And 3, what type of access do I get? when it comes to the decision of mutual funds versus ETFs or building this strategy around a mutual fund share class of an ETF, we really looked at all of these angles. So we are gonna, I mean, if we do this right, which we will, because we have been studying this for many, many months, we will be able to offer something that is cost effective because it takes advantage of the size and scale of our ETF business. We now have $1.7 trillion in ETF assets. So we do have the power of scale. We also have the power of content because we have hundreds of strategies that today we are offering through ETFs. And once you combine content with cost, you have something that investors may benefit from, and that includes retirement assets. I mean, in the end, we are also laser focused on today because this is what catches the attention. This is what we watch every day on TV, how markets are doing, how companies are doing. We are so focused on today that we may lose sight of tomorrow. Am I going to retire? When am I going to retire? Am I going to retire with dignity? And how hard is my money working against those goals? So we want to build an engine, we want to build an infrastructure that really allows pension plan and plan participants to benefit from the beauty of ETFs, the content and the innovation of ETFs with the costs that can be compressed through, size, scale, and technology.
It's interesting, Todd, to get to your point on this. We've spoken a lot, not just on this show, but in various parts of the ETF industry, about just how much of a game changer it could be when we actually see ETF share classes get greenlit for these mutual fund companies. We haven't explored as much the reverse, right? What Anna is saying, that some of these ETF providers may actually be looking for mutual fund type share structures, if you will, to address this. How much do you think that this is going to be adopted by other ETF managers, whether they be passive indexes or active ones, to try to convert to a mutual fund type product to satisfy some of that retirement investor demand?
So I think this is a big thing for asset managers to figure out how to support both the mutual fund community with their ETFs and the ETF community with their mutual fund strategies. There's a lot more firms that have lined up to move their mutual funds into the ETF area and arena, but there's firms like State Street, like FM Investments, that has filed to offer the strategies in retirement plans. So it's really exciting. This is something we're watching for 2026, and I'm excited to see what Anna and team at State Street bring to market.
And Todd, one of the other aspects that we had mentioned before is the tax aspect of it, which is why retirement plans maybe are more suited towards things like mutual fund products. How much are the current investors today who are at least eyeing retirement or actively approaching it itself, retirement, going to look at some of these mutual fund type products because they don't have to worry as much about the tax implications as other investors, say, in ETFs do?
So I think investors that are looking towards mutual funds in this environment are doing so because that's the choice that's available to them. I don't know that as many people are voluntarily choosing a mutual fund relative to an ETF when they're side by side and they're both available. But because mutual funds make up the majority of the retirement programs that Anna was talking about, mutual funds are the way for ETF-oriented companies to get exposure to that and to meet investors where they are. So some people are in the ETF space if they're building their portfolios themselves and are in more taxable accounts. If you're in a retirement program, mutual funds is the game to be a part of.